What I'm going to do now is I'm going to pull up chapter 11. It's going to be a little more show and tell, not too much, not heavy on spreadsheets, and talking about returns, different types of investments, and risk. Give just a second for my people to load the PowerPoint presentations up here. I got a crew working in the back room. They just said they just need a couple more seconds here. All right, excellent. Thanks, guys. All right, let's talk about risk and returns. So we're going to go through a change now. The last couple of weeks, we've been talking about how to analyze investment projects by estimating cash flows and the NPV, right? Now we're making a change, because up to now, we've kind of taken the discount rate that we use in calculating NPV. We've taken it as it's been given. We haven't really talked too much about where it comes from. And so now we begin that discussion of where that discount rate comes from. And that discussion starts with how we measure returns on investments and how we measure risk on investments mathematically. So this is actually going to go more into the discount rate. And what we're going to see, just to give you a glimpse of the future here, is that the returns that we're going to use are going to feed into the discount rate. So the returns that we see on the stock of a company, the returns that we see on the bonds of a company, those feed in together to become the discount rate for the company. Sounds kind of crazy. Oh, sorry about that. But that's kind of where we're going with this. We're going to look at expected returns and expected risk on stocks and companies, and we're going to end up using that to help us determine the discount rate for a company's project. So here are some of the learning objectives we got for this chapter. We're going to calculate the rates of return for an investment and its two components. We've kind of already done that, and so that shouldn't be too big a deal. We're going to estimate the opportunity cost of capital for average risk projects. And that's our discount again, right? Our discount rate. We're going to look at how we measure risk, and how we do that in finance is by calculating the variance and the standard deviation of like stock returns or bond returns. And that's going to be just like you did it in your introductory statistics class. So that shouldn't be too bad. Then we're going to talk about the relationship between risk and returns for different types of securities. We're going to look at really risky securities with really high returns. We're going to look at really safe securities with, you guessed it, low returns. And then we're going to talk about how we separate risk into kind of market risk and unique risk. And this is where the whole financial concept of diversification of your investment portfolio, this is where it comes into play, because diversification can be used to reduce risk. All right, so let's take a look at this first slide. So what this shows is if you took $1 over 100 years ago and you bought either a share of stock, a U.S. government bond, or a U.S. Treasury bill, what would happen to that $1 after over 100 years? And assuming you reinvested all your interest or reinvested your dividends, you reinvested all your money back in, so you allowed that investment to compound growth, to grow with and compounding by reinvesting all your earnings, right? So the red line is common stock, and that's that's the average stock in the market. So they look at the overall market return, year to year to year to year over 100 years. The blue line is U.S. government bonds, so that would be Treasury bonds. And so they're bonds, so that means they have a greater than 1 year maturity. And then the green line are, people usually call them T-bills, but they're United States Treasury bills. They're not bonds, they're bills. And bills are defined as having a maturity less than a year. Okay, so, and that green line, you can kind of think of as almost like cash in the bank. Because if you were to put money into your money market account at your bank or with a stockbroker, you're probably earning returns around that T-bill rate, or maybe even a little bit lower, which right now is what, like, I don't know, I can't remember. Is it 0.1%, something, some measly amount like that? So a couple things to see on this chart. First off, notice the scale on the left-hand side. It goes from 1 to 10 to 100 to 1,000. This is a log scale. And the reason people use log scales is because when you have huge differences between lines on a chart, using a log scale kind of compresses everything so you can see it on one chart. And without using log scale, that red line would be about 100 times taller than the blue line. It's a huge difference. So what's this saying? If you look at the red line, you notice how it has a lot more, up and down movement in there. And this, so think about this as the stock market. In the short term, like over the next year, 2 years, the stock market can go up and down quite a bit. And that is how we define risk in finance. It's that amount of up and down movement. It's our ability to predict where the market is going. With stocks, all that up and down makes it hard to predict. Therefore, it's considered riskier. Okay? If you look at the blue line, the government bonds, notice how it's a lot more stable. It doesn't move that nearly as much as the stocks. So it's considered safer than stocks. Government bonds are considered safer than stocks because their returns are easier to predict. They don't move up and down as much. And then on the green line, those are our treasury bills. You can almost think about that as cash, right? And that's very, very easy to predict. We know what our returns are going to be when we put money in cash or T-bills. And so that's why that's like considered the least amount of risk. But so risk has a big factor on this slide. But look at the difference in terms of how much $1 investment grows after 100 some years. It's not even close. This is why financial planners, as long as you have, a couple years until you need the cash, they will recommend, a good chunk of your money, usually the majority of your money, be in stocks versus cash. I mean, cash, usually the green line, you would put in something like, 3 to 6 months living expenses if you have the money to save that for that. And then the rest of it should be in a balanced fund, depending on your age. If you have 30 years until retirement, they might say 70% in stocks, 30% in bonds. But you can see the reason is because, after, and this is over 100 years, but after 20, 30, 40 years, the amount of money difference is substantial. In fact, in financial research, they've looked at the portfolios of individual investors, not professional investors, not hedge funds, but individual investors. And they looked at the performance of their investment portfolios. And the number one predictor of the performance of their portfolio was how much they put in stocks. So if they didn't put a lot of money in stocks, they did poorly. And if they put a lot of money in stocks, then they did really well. It didn't matter if they picked Procter and Gamble or Tesla for a stock. It didn't matter if they picked Amazon or they picked Microsoft or they picked Ford Motor Company. The stock picking really didn't make much of a difference. It was more about whether or not they were invested in the market. That was the key predictor of how well their investment portfolio did. Because if somebody has, half of their money sitting in a bank account, it's cash. And you're going to see on the next slide, when you start taking out things like inflation, it doesn't grow at all really over a long period of time. So this slide, I just changed the slide. It's hard to see. So right now it says real dollars. So this is the exact same slide as the last one, except we've taken out inflation, right? So what this really does is it shows you purchasing power, and so you can compare your purchasing power in 2004 to your purchasing power in 1900. Okay, and so you can see the red line shows that after over 100 years, your purchasing power goes up by 700%, right? But if you look at the blue line and the green line, your purchasing power went up between 200%. Oh, not so, but it went up. It went up much less, right? So you think after investing money for over 100 years, you would turn $1 into more than $2.80 in purchasing power, but that's like. And if you look at that over a 20-year basis, you're kind of just treading water. And if you look at the returns today in Treasury bills, if you're going to make 0.5% per year, I got to think that inflation is probably going to be at least 2 or 3% this year. So any returns you're going to make on money sitting in cash are probably going to be eaten away by inflation. So that's kind of what this slide shows you. It's one, the incredible difference in returns over the long term between stocks, bonds, and T-bills, and also a kind of a graphical representation of what we term risk. Timothy just made a comment about taxes as well on those capital gains, and yes, that's true. On those common stocks, you have capital gains taxes, but capital gains taxes, as long as you're invested for more than 1 or 2 years, they're not as high as labor taxes, right? So you get taxed less on capital gains than you do on your own labor. But yeah, this is not after tax, so that's a good comment. All right, let's talk about how we calculate returns. This is just that holding period return equation that we covered a couple weeks ago, right? We include all of the returns that we get on owning the stock, dividends, and price appreciation. And this can be broken into 2 parts. This part on the left here, that's called the dividend yield, and the part on the right, we call that capital appreciation. So it's important when we reinvest our dividends, that allows us to compound growth, right? And that way we kind of get interest on our interest. And we talked about that before. And so all these statistics we've been looking at, they assume that you take your dividends and you reinvest them in the stock. So now I want to introduce a concept called risk premium. And the risk premium looks at the total return a different way. We just looked at total return separated into dividend yield and capital appreciation, okay? But now we're going to look at it a different way. And what this does is it takes total return and splits it into the risk-free rate and the risk premium. We define the risk-free rate, at least in the United States, as the U.S. Treasury bill rate. And for us, the U.S. Treasury bill, it's about as risk-free as we can get. So as long as the U.S. government does not default on Treasury bills, we won't have any type of risk exposure. It hasn't happened yet, knock on wood. And that risk-free rate, think of it as like a baseline rate. So if you have a project with zero risk, the required return is the risk-free rate. Okay, so that's kind of the baseline minimum rate of return, that risk-free rate. Anything above that is where we're adding on more risk. So that's why we call it the risk-free rate plus the risk premium. So for any amount of risk higher, there's going to be a higher return associated with that based on the risk premium. So a riskier company or riskier stock will have a higher risk premium. Now we can use this another way. We can analyze the returns of the stock market over the last 100 years, and we can calculate the average risk premium over those 100 years. And it turns out it's somewhere around 7.5%. So depending on what the risk-free rate is in any given year, what this means is you can take that average risk premium over history, add it to the current risk-free rate, and that gives you kind of a simple way to estimate the total return on the stock market for any given year. That's what we did here on the next slide. So what this shows here is that we take the current Treasury bill rate, which is the risk-free rate, and that can vary over time, right? The risk-free rate, Treasury bill rate varies over time. Right now it's super low. Back in the 70s, 80s, it was like 15% or something. So it does vary over time. And then we take the average risk premium that we've seen over the last 100 years, because that's something that does vary. And we don't know what it's going to be. The risk-free rate, we know it's going to be over the next year because we have that risk-free Treasury bill that we own, so we know what that interest rate is going to be over the next year. But the stock market, we don't know what the return is going to be over the next year. So we take the average over the last 150 years and we say that's just our best guess. That's our expected number. So if we add the current interest rate on the Treasury bill to the average risk premium we've seen in history, that gives us the expected market return for the current year that we're in. And so you can see, 1981, the expected return was 21.6%. 2008, it was 9.8%. And for this year, it's going to be something like 8% or a little bit less, because right now Treasury bill rates are less than 1%. And so you take less than 1% and you add it to the historical average of 7.6, and you get somewhere around 8% expected market return. So it's this expected market return that becomes our opportunity cost of capital that we use for the discount rate on our projects. Because investors are investing in the market and they can earn a certain amount of return. They expect to earn a certain amount of return. And you have to meet that expected return for them to be able to give you money to invest in your company. So you kind of have to have offer them that same return. So that is opportunity cost of capital. It turns out that this risk premium, it actually varies across countries around the world. I saw this myself several times, depending on where we would do projects. If it was in like the US or Brazil or Belgium, Germany, Denmark, Southeast Asia, India, different countries have different risk premiums. And why do different countries have different risk premiums? It can be due to a bunch of different things. Why would countries vary in their amount of returns that investors in those countries require? It could be, the tax laws are different. It could be the legal system. Maybe in one country, companies have a difficult time operating. They're afraid they're going to get, they're going to have more trouble earning profits. So then they might have to say, okay, we'll do a project in this country because it's hard to earn a profit in that country, we want a higher return. And that shows up in the risk premium. So tax systems, legal systems, corporate governance. Companies are kind of governed by the governments in which they operate. And depending on the climate toward businesses, depending on how easy or hard it is to operate a business, that will affect the risk premium. And so if you look on this chart, I'm not exactly sure why Italy is so high. Japan's pretty high. And then you have Denmark and Belgium being pretty low, Switzerland being pretty low. Usually the higher the discount rate for a particular country, there's some riskiness in those countries. So I don't see China on here. So that's just something to consider, that countries do have different risk premiums. And so when you do projects in different countries, the same project will have a different discount rate in different countries. All right, here's another way to represent the riskiness of different types of investments. So what we have here are common stocks, treasury bonds, and treasury bills. And so these charts, they're actually histograms. And a histogram basically is a chart where every observation you have in a certain data range is marked as 1 point. And the more observations you have at a particular number range or data range, the higher the bar will be. So if you look here under common stocks, do you see how around minus 45, it has a little bump right there. But then at minus 40, it's basically zero. So what this says is that the common stocks have had a return of negative 45%. It looks like maybe once or twice, but they've never had a return of minus 40% because that's zero. And so the higher the bar here, the more number of years that occurred that had that stock return in that range. And so you can see the most common returns were like 0% and then 20 and 25%. But it's a really big range, right? It goes from minus 45 up to 55. So what's it going to be in any one particular year? It's hard to tell. But now take a look at lower here at the treasury bonds. You notice how that distribution of returns is narrower? And so for treasury bonds, when we look at history, returns went from about minus 10 to about 20% per year. That was the range. And then when we go down again to treasury bills, look at that. It's somewhere between 0, 5, a couple years of 10%. So that's a very narrow distribution. And so that's the history. So just imagine if someone said, hey, I want you to guess what the returns will be on either stocks, bonds, or T-bills next year. Which do you think would be the easiest to predict? It would be treasury bills, right? Because one, we kind of know what the return is. And if you look at the history, there's a narrow range of the potential outcomes. And so So how do we measure this risk? Because what this is showing is risk. Treasury bills, very narrow range of outcomes, low risk. Common stocks, wide range of potential outcomes, high risk, because we don't know, we have a harder time estimating what the actual outcome will be. What measures this is variance. And if you remember your statistics class, remember that you had the normal curve that went something like that, and they talked about distributions, and it was something like for a normal curve, I think plus or minus 2 standard deviations was like 60 or 90% of the population, something like that. And so we don't quite have normal curves here, 95%. Thanks, Timothy. But you can kind of see how it's a population curve, right, for these. They're not perfect. They're a little skewed, kind of skewed to the right a little, skewed positive, if you will. But that's kind of what they are. And so this leads us to how we're going to measure risk in security returns. It's going to be by using variance and standard deviation. And that's where we get the next slide. So we're going to measure risk using variance. And then on the next slide, we'll take a look at standard deviation. And the easy thing about that is it's just the square root of variance. So you see here this letter right here, this symbol. This is the Greek lowercase symbol for sigma. It's kind of an O with like a little swoosh. And when it's squared, that means variance. Okay, so sigma squared means variance. And conversely, sigma by itself, not squared, is going to be standard deviation. So you may have heard before in statistics where you take the sum of squared errors. So that's what variance is. You sum up all the error terms that have been squared, and you take the average of them. That's what variance really is. And so you can see from this chart, R1, R2, all the way up to RT, the end of time, whatever we're going. Those are individual returns, like for every single year. And then this R with a bar over it, that's the total average return of all the years. That's this right here. And then what we do, we call these error terms. So the return for a given year minus the average is called an error term. And then we square that. So that's where the squared errors comes from, if you remember some of the statistics lingo. And then you sum up those squared error terms, and that's the whole numerator up here. And then you divide by t, like we're taking the average, based on the number of observations, which is t observations, and that gives us the sum of squared errors, and that's our variance. Okay, so on the next slide, I'm going to go through a mathematical example of how to calculate variance. It comes pretty much from your textbook. I'm going to go through it kind of step by step by step. But basically what we're going to do is first we're going to calculate this R bar in this equation. And then we're going to calculate the return for each year minus R bar. And then we're going to square each of those terms. Then we're going to add them all up. And then we're going to divide by t. But we kind of break it down step by step, kind of like it does in your textbook. After we do that, then we're going to go into Excel, and I'm going to show you how to calculate the variance and standard deviation in Excel, and that'll take about 10 seconds, okay? All right, so standard deviation is just the square root of variance, and so in using Greek letters, we just say sigma equals the square root of sigma squared, all right? All right, so let's go ahead and calculate variance. So here's the basic equation of what we're going to calculate. So let me first off explain the rest of the stuff on the slide. So right here is the return in year 1, and then we have the return in year 2, and the final return in our series. And those returns are all listed right here. So for like 2002, we had a return of negative 20.9%. And the next thing we're going to do is we're going to calculate the average return for all years, because that's going to be used in our calculations. And we do that right here. So we sum up all the returns, right? That equals 51. We divide by the number of returns, the number of observations, that's 6. And that gives us an average return of 8.5%. Any questions on any of that so far? I know it is a little dense, this slide, but kind of taking it step by step. And then the next step is to take the return for each year and subtract the average. And that's what's done in this column right here. So minus 29.4 basically represents the return in the first year minus the average. So minus 20.9 minus 8.5, we get minus 29.4. And then we do that for all the years in this column. And then the next step is to square all those terms, and that's what's done over here. We took that minus 29.4 and we squared it, and we get 864.36. So that represents this whole term right here. And then we basically add up all these squared terms, and we get 1480, right? And then we take that and we divide it by the t in the bottom of this equation, which is the number of observations, or 6, and we get 246. So that's our variance, 246. Variance is a number that's kind of difficult to conceptualize in your head. So usually when we're expressing risk as a mathematical number, we prefer to use standard deviation. So the standard deviation is just the square root of the variance. And in this case, it's going to be 15.71, right? Because once we know 15.71%, if you're comfortable with variance, then we say plus or minus 2 variances is 95% of the population, like in a normal distribution. And some people are more comfortable with that because it's easier to conceptualize. I know that was a little bit dense way to go through an equation, but it is kind of how your textbook does it. What I want to do now, I'm going to go through and show you in Excel. So I'm going to just list the returns that we have listed here, and these are all in percent. This is the same thing that was listed on the slide. So then if we want to calculate variance, hey, do any of you guys remember in your statistics class, did you talk about population variance versus sample variance? Does that ring a bell at all?
Yeah, that sounds familiar to me.
Yeah, so for our purposes, we're going to use population for everything, okay? So that's our default. We're going to use population variance and population standard deviation. And I think that's what the textbook uses. And if anybody wants to talk about it, I can talk about it after class here, when you would use population and when you would use sample variance. So it's just an easy formula in Excel. It's called the var formula. But then if you're able to read this here, we're going to use the var.p, and that's the variance for a population. And the reason we can use that is because we want to know the variance for these 6 years that we got. And the 6 years is the total population. It's not like, we sampled 10% of all the years. No, it's just 2002 to 2007. That's our whole population. That's all we want to know about. So we can use population standard deviation. And then it's pretty simple. You just select the range of your numbers in Excel, just like that. Little end parenthesis, and there's your variance. And that's exactly the same number that we got doing the math on the PowerPoint slide. And then we have standard deviation. And standard deviation also has a formula, and it's going to be the same deal as the last one where we're going to choose the population formula. Okay, and so it's STDEV, and then the .P just stands for population there. And it's the same thing. You just do your open parenthesis, and you go ahead and select your sample range or population range. And I think that is, yeah, we got 15.71% doing it the other way. And so that's the same as what we got before on the slide. And here's the formula. Okay. I want to do one more thing here. I'm going to calculate the standard deviation using the square root. And I just want to make sure that it's exact same as what we got using the standard deviation formula. So if we take the square root of this variance right here, we should get the exact same answer as using the standard deviation formula. And yeah, that's the same thing, right? So that works. So when you guys have to calculate standard deviation variance, you can do the math with a calculator by hand, but it may be, if you really want to do that, just double check yourself, because I know your calculators can do it, but you can also do it in Excel, and you can see it's pretty darn easy.